Learn Crypto TV family, what's happening today? So out here on a different type of mission, have to do with Colombia, but I'm over here in the good city of Orlando, Florida over here today, and getting ready to go into the Colombian consulate. I have an interview today for my visa, so I'm getting ready to go in here, see what this process is all about. So those of you who are interested into knowing what this here entails, then I'll be able to give you a detailed breakdown, especially on the other side when I come up out of the interview and everything is done. But that's what we're doing today. We definitely have crypto conversation, but before get into the conversation, random conversation about travel and about Colombia and about getting visas and stuff like that, and on your way to becoming either a citizen or gaining residency or getting a digital nomad status or whatever, be able to make your stay longer in the country that you choose to live in. Like I said, it doesn't really have to be Colombia, it could be anywhere, but my choices happen to be Colombia, so I'm going for everything that I could get, what I'm saying? So that's what we're doing here, but we'll have other conversations, like I said. But before that, we want to look at a strategy that you can use in crypto in order to be able to grow your portfolio. It's called DCA, a dollar cost average. Take a look at this video right here and then find out what you can do in order to be able to get your portfolio set, especially with those ISO 20022 cryptos. I'll see y'all after the interview. Crypto King is not a financial advisor.
You gon' learn today, you gon' learn today, you gon' learn today. Had to get it off, why not be the boss? Started in Tampa Bay. Life in the matrix will crumble you. Poverty struggle will humble you. Florida State, relocate, pack my bags and I moved to Colombia. Hola mujeres bonitas, they say that it's cheaper to keep her. That's why I learn more than you. Crypto, I'm learning you. Learn Crypto TV is turning to. Please don't waste my time. Learn, yeah. Please don't waste my time. Learn today. Crypto TV. Please don't waste my time. Learn Crypto TV. Please don't waste my time. Learn Crypto TV.
Welcome, family, and thank you for tuning in to Learn Crypto TV. When is the best time to invest? The answer to this age-old investing question is deceptively simple: when the prices are low. However, trying to time the market and waiting for the best time to buy or sell an investment is extremely difficult. Fortunately, there's a time-tested strategy that can help you buy more when prices are lower and less when the prices are higher. It's called dollar cost averaging. Dollar cost averaging is the practice of investing a fixed dollar amount on a regular basis, regardless of its price. It's a good way to develop a disciplined investing habit and be more efficient in how you invest and potentially lower your stress level as well as your costs. Let's say you invest about $20 every month. When the market is up, your $20 will buy fewer shares. When the market is down, your $20 will buy more. Over time, this strategy could lower your average cost per share compared to what you have paid if you bought all your shares at once when they were at expensive average. Let's check out this explanation.
Imagine that you want to make apricot compote. You can buy 10 pounds of apricots for $1,000 all at once, meaning 1 pound is worth $100. Or you could buy them in retail. At the beginning of every month, you buy a pound of apricots, but prices vary, meaning sometimes 1 pound is worth $110, other times it is worth $90. In the end, using the lump sum version, you would have gotten 10 pounds of apricots for $1,000. But using the DCA strategy, you may end up with 10 pounds and 7 ounces for the same amount of money because of the change in price. This is basically what DCA is all about, so stay with me to the very end of this video, because I am going to explain what advantages this strategy has to offer. What is dollar cost averaging? The DCA, for short, is an investment strategy which has the goal of reducing to a minimum the impact of volatility. It is also known as unit cost averaging, incremental averaging, or cost average effect. In DCA, instead of making one single transaction, the investment is divided into smaller amounts, which are invested at regular intervals. DCA tries to minimize the risks associated with volatility by lowering the general average cost of an investment. Promising, right? We promise to deliver interesting crypto content. So, if you liked this video so far, don't forget to like, comment, and subscribe. How DCA works. Let's say you wanted to invest $500 in DOT across a 5-month period between June and October 2021, meaning $100 every month. The prices of DOT for each of those months were $27.01, $16.86, $31.47, $37.38, and $44.88. With this money, you could have purchased 3.7 DOT in the first month, June, followed by 593, 317, 267, and finally 222 DOT in October. After these 5 months, you have a total of 17.69 DOT. In November, the price of 1 DOT stood at 53.88. This means that the profit you could have registered was $453.13 above your initial investment. But if you had invested all $500 at once in October, you would have had 11.14 DOT. That means that in November, when the price of 1 DOT was 53.88, your fiat equivalent of that would have been $600, with only 100 above your initial investment. Naturally, it goes without saying that this strategy doesn't always lead to profit, or can it always offer you protection when the prices of crypto are falling. One of the opposing strategies of this is timing the market, in which you try to predict the performance of an asset, which makes it an active strategy. DCA, on the other hand, is a passive strategy because you don't have to follow the market trends, and you invest the same amount of money on a regular basis. The benefits of DCA. DCA comes with several benefits, such as the fact that it reduces investment risk and capital is used to avoid a market crash. It preserves money, so there will be liquidity and flexibility when it comes to managing an investment portfolio. Purchasing market securities when the price is falling makes sure that an investor will receive higher returns. The DCA strategy basically lets you purchase more crypto than if you had bought when prices were high. The DCA strategy also means that you invest smaller amounts periodically in declining markets, and your portfolio will maintain a healthy balance, thus leaving the upside potential of your portfolio to grow in the long term. Furthermore, because nobody can really predict the way crypto market swings, the DCA strategy allows for a smoothing of the cost of purchase, which is to your advantage. Conclusions. DCA represents a practice in which an investor allocates an established amount of money at regular intervals for a period of less than 1 year generally. The strategy tends to work best when it comes to volatile investments such as crypto.
You're gonna learn today.
Well, family, so you can see I'm walking down the hallway. I'm leaving the consulate, and you can see nice good old taste of Colombia right here. You know what I'm saying? Serving Traeger. That's what caught my eye right there. So you can get the, get the stuff, man. Well, as you can see, I'm walking out of here, done with my interview. Think it went well. I still got to give them 2 more documents that I didn't have. Well, I had one, but it would just be easier for me to upload them both all at the same time. So what I'm doing, pretty much, and I didn't realize how many Colombians was here in America, man. But I guess if you got a consulate, that you will definitely have that nationality here. So but it was a unique experience, to say the least, and we'll see the outcome. So basically, let me get downstairs, and then we'll resume once I get out of the elevator. All right, family, so I'm outside now. So if you didn't know, here, this is the building where you would come for the Colombian consulate here in Orlando, Florida, for you guys in Florida. But anyhow, so if you need to, I will be conducting official business here, in regards to any visa status or any type of official paperwork that I got to get done. I know I got to ride over here to Colombia. So you guys who travel, you know what I'm saying, what you can do is check to see what is the closest Colombian consulate to you, because I would imagine if you were somewhere in like New York or Chicago or LA or Houston or something like that, then you wouldn't be coming all the way to Florida to go to a consulate here, for Colombia. So I would say check in your area to see what will be the closest one to you, and then from there, do what you got to do. But anyway, let me find my vehicle, and then I'm gonna get with y'all momentarily. Well, let's just talk about a little bit about the benefits of dollar cost averaging. We know that it establishes good investing habits. Now, even though you know you should be investing regularly, sometimes it's tempting to spend the money earmarked for investing on other things. If you set up regular automatic contributions, you're less likely to miss the money that you have earmarked for investing and more likely to develop investing discipline and stick to your plan. It also keeps you open to other opportunities. Market timing or trying to pinpoint precisely when the market will reach its peak or hit the bottom and buying and selling accordingly is just about impossible, and even for professional investors. Now, dollar cost averagings help to ensure that you'll be at the door when the opportunity knocks, and recent events offer an example as to why a steady investment strategy is so important. If you stopped investing leading up to the 2016 US election results, when uncertainty drove the markets downward, you may have regretted your decision in the days that follow when the market surged to record highs. Dollar cost averaging may also help to prevent emotions from undermining your portfolio. This is also called minimizing regret. When you invest a large sum of money in a single trade, for an example, you may feel more likely to regret it if the trade turns out to be poorly timed. Behavioral economists note that most people are inherently loss adverse. They tend to react more strongly to losses than to gains. But with dollar cost averaging, you're investing smaller sums of money over time and making it easier to stomach a poor, timely investment. Okay, Learn Crypto TV family. So I'm back in Tampa. Once I got back, I had to get on the clock and do some work. So now that I'm off the clock, and I don't have to do anything, for the rest of the day, I can bask in the news that I get to give to you guys, and you learning it with me here today. The day that you saw me go over to the Colombian consulate, they actually approved my visa. So I have the M-type visa for Colombia. So it's a 3-year visa, and I get to apply for residency in 2 years of a 3-year visa. Isn't that exciting? But one parameter is that I have to go there every 6 months, and I have to stay a few days every 6 months so the visa doesn't expire. So, but that'll be easy. You know what I mean? That won't be hard to do. But this opportunity now has opened me up to be able to open up additional credit lines in other locations within the country. I can move around and do other types of investments there and stuff like that. Because now I will be considered quote unquote a citizen. You know what I'm saying, of the country of Colombia. So, man, I'm super excited about that. Y'all don't even understand, man. I've been living in Colombia for 31 months, and this journey it started in 2019. You know what I'm saying? So I'm just real excited right now. I kind of want to jump up here on top of the roof and scream it out to the whole city of Tampa, but we're not gonna do all that. We're gonna share it right here. Hopefully, you can feel the energy here on the screen right here, just talking to me right here. But if you are looking to do something like this, I'm not telling you to get the M-type visa. The M-type visa is the strongest and the best visa that you can have in Colombia. The M-type visa. What is the M-type visa? That's the marriage visa. That's what that is. So because I'm married to a Colombian national, that allows me to be able to get Colombian citizenship. So the M-type visa is by far the strongest visa that you can have. Then you also have the investment visa. You have to invest like $50,000 in a property or business or something there. Then that'll be the next strongest visa. Then you have the retirement visa. Those individuals who are over 55, 65, that's in retirement phase, and you getting a pension, that's relatively easy for you to get. It's something that only a few people in that sector talk to, because not everybody that's in retirement age wants to go and live in another country. You know what I'm saying? So, but anyway, that's a strong visa as well. So those are the 3 strongest visas: the M-type visa, the retirement visa, and the investment visa. So all of those you can apply for residency at after 3 years into the visa status, or 2 years into the visa status. Then next you had a digital nomad visa. The digital nomad visa is going to be for 2 years, and you have to I think you have, it's for 2 years. You don't have to reapply. It's for 2 years for the digital nomad visa. So You know, that'll be one that for those of whom who work remote, have a remote job, and you like to move around and stuff, and you can work it anywhere. You know, as long as I know a time zone thing is something that you have to consider and think about too as well. But those types of things you want to be able to move around and do with a remote job. That digital nomad visa will be the one that you want to go after and get. Also, then you got you know, the student visa. That's another visa. You know, that's a 1-year visa. There's not much privilege that comes along with that outside of you being able to study inside the country. You got the work visa. I did that one. You know, if you're an American and you going to Colombia and you working on a work visa, I'm gonna tell you right now, the pay is not gonna be equivalent to what you would make over here in America as what you would make over there in Colombia. So the work visa is kind of tricky, you know what I'm saying? Unless you're working for an American company that's based in Colombia, that you're making USD, and they are able to sponsor you and to provide a work visa for you to be able to live in Colombia and conduct business with that company, then that'll be a way around that, so you can still make USD that way. But with the Colombian work visa, I mean. And then the last visa is if you as an American, your regular blue book gentleman passport, bro, regular passport traveler visa stamp. And in that you get 90 days, and then you can reapply for an additional 90 days, which gives you a total of 180 days or 6 months inside of Colombia to be able to live, work, play, do whatever it is that you're going to do while you're there. So those are the visa types, you know, that you can apply for while you're in Colombia, or to be able to get inside of Colombia or stay in Colombia, or whatever it is that you wish. I'm talking specifically to this country because that's what I know. That's my experience. I can't speak to any other country. You have to go check out other channels, you know, if you wanted to know information about those. But anyhow, outside of that,
Warren Buffett has said that he made a large percentage of his fortune by taking advantage of discounted investments during the Great Recession and waiting for their prices to recover. By employing a dollar cost averaging strategy over a long period of time, the emotion is left out of the game, giving you the ability to make money during times of turmoil as well as the boom times. As simple as this method is, it's a very effective and strategic way to invest. As you buy more shares when the market is down, the average cost per share is reduced over time. This method is particularly useful for new investors who are just getting started out and are looking to add to their position. Say you just received a large windfall of $100,000. Would it be wise to invest the entire sum in the stock market on a single day, or would it make more sense to buy $10,000 worth of shares over a few months' time? Investing the money over time is less risky because it's impossible to know what the markets are going to do next. It's clear that investors have no idea how to predict the future of stock. Just look at some investment news articles and you'll see so-called experts with wildly different predictions on when the next recession is going to occur. Some say there isn't one in sight, and others predicted that there was going to be one 5 years ago. Stocks could drop due to looming turmoil, or they could rise abruptly due to positive economic news. By dollar cost averaging, you're essentially diversifying the price at which the investments are purchased, ultimately lowering your risk. Employing this investing strategy takes the emotions out of the game, which tend to run unusually high when the market is either doing very poorly or hitting all-time highs. Investing the same amount of money every week will allow you to worry about other things that are perhaps more beneficial, like your budget, family, and career. For most people, they're better off financially worrying about how to optimize their time, productivity, and income during their hours at work and investing automatically. We've seen it happen before. When there's a disruption in the stock market and prices start falling, small mom-and-pop investors often panic. They stop putting money towards their investments and sometimes sell everything. Then when the market turns and finally recovers, these people gain confidence once again to start contributing to these accounts. But the majority of the profit has already been made by this time. If you set up an automatic contribution to your investments on a regular basis and set it and forget it, so to speak, you can keep your portfolio on the back burner while you go about your everyday life. For example, assume an investor deposits $1,000 on the first of each month into index fund XYZ, beginning in January. Like any investment, this fund bounces around in price from month to month. The investor keeps steadily putting $1,000 into the fund on the first of each month, while the number of shares the amount of money buys varies. In January, $1,000 bought 50 shares. In February, it bought 62.5 shares. In March, it bought 83.3 shares. In April, it was 58.2 shares, and in May, it was 43.48 shares. Just 5 months after beginning to contribute to the fund, the investor owns 298.14 shares of the index. The investment of $5,000 has turned into $6,857. The average price of those shares is $16.77. Based on the current price of the shares, the investment of $5,000 has turned into $6,857. If the investor had spent the entire $5,000 at once at any given time during this period, the total profit might be higher or lower. But by staggering the purchases, the risk of the investment has been greatly reduced. If the investor purchased all shares on one day, he might have gotten lucky if the share price was low. But he also could have been unlucky and bought on a day when the shares were very expensive. Using this strategy isn't guaranteed to provide you with the best return. If instead an investor decided to invest a lump sum all at once, they could get lucky and buy at a market's bottom. However, it's also likely that their purchase could be made at all-time highs, limiting returns. Your potential risk is reduced when making smaller purchases over a long period of time. Timing the market rarely works. Even professional mutual fund managers have a difficult time outperforming the benchmark, which is why it makes sense for individuals to employ this proven strategy. Not only could your returns be higher, you'll benefit from reduced risk as well. Additionally, dollar-cost averaging is perhaps the easiest investing strategy you could possibly use. Don't be fooled thinking you can limit losses by selling your investments when you think the market is headed down. Instead, keep investing the same dollar amount regularly and enjoy lower-priced investments.
You're gonna learn today.